Hello, this is Scott Hayes. I'm President and CEO of ISC Group. Half of 2026 is already in the books, and so I thought it'd be timely to give kind of a market update, review what's happening with the economy and where we see the market heading from here. Lots been happening, of course, this year, as always. Starting off looking at the economy, if we want to look at some tailwinds and headwinds for economic growth, oil has been a shock this year when the United States invaded Iran back in March. You see here from the chart on the left, this is the price of gasoline in different oil shocks in history. The current one, 2026, the price of gasoline peaked on May the 21st, around $4.50 a gallon. It's down about 72 cents a gallon since then, so it is off the highs quite a bit, which should be a relief for some of the inflationary pressures that exist right now. Compare that to the shock of 2022 when Russia invaded Ukraine. There was a spike significantly higher than that. The price of oil, obviously it hurts when we fill our gas tanks right now. It hurts less so than it has in prior oil shocks. So just because of the fact that if you look at the upper right-hand corner here, we used to import a significant amount of our petroleum products in the United States. Today, we're actually a net exporter. So even though it hurts less than it would if we were more dependent on importing some of that foreign oil. And also gasoline efficiency and so forth. It's a smaller share of our wallet than it's been in the past as well. So that's been a significant headwind to economic growth that has abated somewhat. Another one of the headwinds has been tariff rates, right? Tariffs do make things more expensive here domestically. When President Trump announced Liberation Day back on April of 2025, it looked at the time that the peak tariff rate was going to be as high as it was back in the Smoot-Hawley days, back in the 1900s, that of course preceded the Great Depression. Since then, a couple of international courts have ruled they're illegal. As we sit today, as of June 30th, the effective tariff rate is around 10.7%, the blue line on the right there. So while that's still higher than it's been historically, it has come down considerably from the highs. More recently, we've been doing tariff refunds where importers were charged tariffs that were ruled illegal. And in fact, in the second quarter of 2026, our net tariff revenue was a negative $25 billion because of paying those back. Drivers of economic growth, we do have an immigration squeeze right now. You see that if you look at drivers of GDP growth over time in the upper right-hand corner here, our growth in real GDP equals, take you back to high school economics, growth in workers plus growth in real output per worker. So if the number of workers goes down, you actually have to have growth in output, meaning that each worker that remains is more productive than they've been in the past in order for economic growth to continue going forward. So here we are today with the mandate that we get immigration under control and the borders under control. We've lost about, from what I understand, the status from JP Morgan, 500,000 or so working foreign-born persons in the workforce. And about 600,000 domestic workers have also left the workforce during this time frame just because of retirements or what have you. They've left the workforce. So we've had a net negative 0.4% in the growth population, which is a drawback, obviously, for GDP when you see that that's the primary, that and output are the drivers of economic growth. So that's another structural headwind to long-term growth that will remain with us for some time going forward. Big news, of course, today, all we hear about is AI, and the major hyperscalers, the Mag 7 that we've talked about in the past, all the big tech companies have been spending hundreds of billions of dollars building out AI infrastructure and data centers and that sort of thing. You can see here that in 2025, the hyperscalers spent $416 billion on infrastructure, on cap expenditures. They forecast that to grow to nearly $1 trillion by 2028. So that has ripple effects throughout the economy. When they're spending these hundreds of billions of dollars, that feeds into the suppliers and the supply chain and workers' wages and so forth. And so that's been a big boost, obviously, both to the economy and to the stock market. If you look at the right-hand side of the page here, you can see the green line is how the CapEx has grown. The capital expenditures have grown for these hyperscalers significantly and will continue to do so for a while. But unlike the dot-com bubble, when everybody was building out these fiber optic networks across the country, recognizing that the internet was going to be the next big thing, which it was, there were no revenues behind a lot of that. Where these hyperscalers, Alphabet, Amazon, Meta, they're making the money, their operating cash flow is still exceeding those right now. It will be interesting to see, how that plays out when they start borrowing more money to fund these projects going forward. But right now, that's been a big input into growth. We've shown this slide before. This is a 2026 federal budget deficit, the budget and the deficit. This shows you on the left-hand side here. We're committed to spending $7.4 trillion. We're going to bring in about almost $2 billion or $2 trillion, actually less than that. And importantly, all of the income that we have as a country, both from payroll tax and personal income tax, just at this point in time, barely covers mandatory outlays, which include interest on the debt, Social Security, and other entitlement programs. And yet, in defense on that, and we're in a situation where we continue to run at 7% deficits, even though we're not in a recessionary environment right now. We are around 100% of GDP in terms of the debt, and it gets ever harder to get out of that as that debt continues to grow. I read just the other day that the Social Security Administration, they projected that the trust fund is going to be out of money by the year 2032. I think it is. It happens to coincide with the year in which I'm eligible for benefits, so that's great. They've actually moved that forward by a full year because of some of the projections that are out there. So we're near the point where entitlement reform is going to happen, and it may not happen until we're up against it, but we are not going to allow retirees to take a 27% cut in benefits, which I believe is what would happen should that date pass with no action. So Congress will fix it. It gets harder to fix every year that they wait. But I do believe that entitlement reform will be on the horizon. We're going to see that. It just has to happen at some point. So we'll see what they come up with there. You may have heard about the K-shaped economy, and I want to touch on that for a moment because that is very important. What this is showing you is that there's been a divergence from wages and profits. And what that means here, if you look on the left-hand side of this chart here, this shows labor compensation. So wages, what we collectively make as a country and workers in this economy used to make up a little more than 2/3 of national income. Since 1970, that's declined to today, it's around 7% of national income, where corporate profits, the ledger on the right-hand side here, used to be 6% of national income. That has grown and grown, and today represents about 14% of national income. So if you look at the chart on the bottom right-hand corner of this slide, this shows you net worth by income cohort. And just as early as 2019, 2020, the top 20% of income cohorts and the bottom 80% were almost equal. So had about the net amount same, 20 bottom 80% owned about the same amount of stuff as the top 20% did. But because of this, the difference being, inflation and the values of real estate, real assets and financial assets, the stock market, we've seen this growing divide where the top 20% now have grown their net worth by $48 trillion versus 17 trillion for the bottom 80%. So there's this growing divergence in worth and net worth and income from the top to the bottom. And so, that's not a good recipe for success going forward. So you're starting to see some, more radical ideas coming out about how you fix that, and even talks of the changes to capitalism itself, which I won't get on a political rant here, but that just that divide between the top and the bottom is concerning macroeconomically speaking. We look at the components of GDP growth. Right in the first quarter estimate was just revised to 2.1%. So as excited as Wall Street is about growth, and we've had back-to-back years, 2024 and 2025, of double-digit market returns, and the first half of the year, the S&P was up another almost 10%. So it's been an incredible run in the market, but the economy is still poking along at a reasonably slow overall rate of return. And things like this business fixed investment, which is the gray area here, it was 1.4% in the first quarter. JP Morgan's expecting that to be down to 1% in the second quarter. So we are going to see some slowing of growth on top of everything. You've heard about, we've talked a little bit about in the past about the concentration of the market. The top 10 companies make up 10 largest companies account for 38-39% of the S&P 500. And this just shows the change in that over time from the 80s all the way up to 2026. So more and more of the market is comprised of, a handful of company names. I've got another slide that I think illustrates a little bit better here in a minute to show you. But when you're owning a broad-based index, you own the S&P 500, you think, well, I've got exposure to the whole market. And really, 38-39% of that is in these 10 names here, which are all tech-based. So, if everything's in an index fund, you get a big downturn. It could be very, very hurtful for returns. Talking just a little bit about the Fed and interest rates. Of course, we have a new Federal Reserve Chairman. Kevin Warsh began his lead at the Fed Reserve just recently, came out with their first meeting and left rates unchanged. The market is kind of forecasting one increase in 2026. One thing that Warsh is not a fan of is the dot plot. We may have talked about that before, where each of the open market committee members, they'll put out their forecast for the next quarter and years and so forth. You put them on a graph, and it shows what they expect rates to be long term. They're going to stop announcing and stop forecasting what they think policy will be going forward. So that's probably going to lead to more volatility around the Fed meetings instead of just being more open like Powell was and putting news out there all the time. We expect we're going to see quite a bit less of that going forward. The yield curve, we have had some recent, inflation upward adjustments and expectations. And you can see here the lighter blue line. This was a yield curve as of the end of 2025. So short-term rates were lower than long-term rates. That's normal. Steepening yield curve, you're compensated more for holding longer bonds than you are in the short end. What happened in this year is that we've seen the short end of the curve jump up quite a bit. On the 2-year Treasury, you can now get 70 basis points more than you could just 6 months ago. And even the long end of the curve has gone up some. The 30-year note touched 5% briefly today. So you have seen some rise in that end of the curve. But looking at the 2 to 5 year horizon, if you're an owner of individual bonds, seems to be a pretty good spot to be right now, because you are getting that 70-ish extra basis points of income. And if inflation expectations do recede somewhat, you could see yields start to fall again. And if they do, that just makes those existing securities more attractive and worth more money. So you could potentially get the return of low fours plus some price appreciation by owning that shorter end of the curve. Across the fixed income spectrum, the gray bar represents the range over the last 15 years. The purplish bar is where the average is, and the blue diamond is where we are today. So basically, no matter what type of fixed income you own, you're still at the higher end of the range. And we believe, again, that fixed income is a relatively good place to be with your dollars right now. I mentioned market concentration, and I had a slide that I like better. This is it. Again, here's the top 10 names in the United States on the left-hand column, mainly dominated by the tech companies, which are the darker gray here: Micron, Broadcom, Microsoft, Apple, and NVIDIA. account for about 22% of the market cap, and the top 10 names account for 38%. Interestingly, emerging markets are even more concentrated on the index side anyway, with three companies representing, they're all AI names, accounting for about 32% of the EM emerging market index, and the top 10 names account for a full 41%. So it's even more concentrated than domestic equities. And we like EM, we like emerging markets, but we think that having active management in that category is more important than ever so that you do get some diversification. The two charts here on the right, Eurozone and Japan, interestingly, these are less dominated by the top 10 names, and they're also less tech heavy. So we find that investing in Eurozone and Japan actually is a diversifier for an equity portfolio today, and we do like those. And skip that. I wanted to show you here, this is a periodic table of returns, what we like to call it. You can see here at the far right, EM equity, emerging market equity, has been the best performing asset class as it was in 2025. Small caps have done great. It varies year to year. You never know what's going to be the best. You never know what's going to be the worst, or you obviously buy that before it happens. But as we always recommend, having an asset allocation model, not putting all of your eggs in the stock market, but having stocks and bonds and spreading it amongst these different asset classes tends to smooth returns. You're never going to have the best performer. You're never going to have the worst performer, but through the retirement plans that we advise, most people are in either a managed model that we run or a target date allocation, which is going to give you that diversification automatically. I've done this before, but I think it's important, so I want to touch on this again. Investing at market highs. A lot of times people do say, well, the market is at an all-time high. Is it really a good time to be in the market? So far this year in 2026, we've had 24 new all-time highs. The S&P 500 closes historically 7% of the time at a market high, and that's been the cheapest you could buy into that market 31% of the time, meaning that the price never went more than 5% below that date's high. So looking at the right-hand side here, investing on any day since 1988 versus investing at a new all-time high, you get almost the same returns, if not better returns, investing at the highs. So really being worried about it from that perspective alone isn't a reason not to be invested in the market. We always show this one too, but again, it's important because we are at a big run-up. Markets do go down, and we forget that in times like this, but it's very normal. Despite the market being positive in 35 of the last 46 years, the average entry year decline in the market has been 14.2%. So it's not a smooth ride. It's never a straight line. And we will get a pullback at some point. And when we do, it should be expected. And if you have cash on the sidelines, it might be a buying opportunity depending on your personal situation. Last thing I want to show you is just the average time to recover from drawdowns based on portfolio type. If you're 100% in stocks versus a diversified 60% stock, 40% bond, kind of generic balanced portfolio, the bigger the drawdown in the market, the longer the recovery time is basically what this is saying. So 10% market drawdown. Historically, stocks have been come back to where they were about 10 months later. 60-40, about 9 months later. But if you get a big one, 20% downdraft takes 2 years to recover historically versus 11 months in a 60-40 diversified portfolio. So, of course, nobody knows what's going to happen. We can't predict the future. We do recommend that you maintain a diversified portfolio. And we recommend that you call us if you have any questions about your own personal needs, or we can give you specific advice to your personal situation. So with that, I'd like to thank you for watching this, and feel free to reach out. Let me know if you have any questions, if there's anything that I can do for you. Thank you.